Top 6 Strategies to Protect Your Income from Taxes. Income is taxed at the federal, state, and local levels, and earned income is subject to additional levies to fund Social Security and Medicare, to name a few. Key takeaways: contributing to qualified retirement and employee benefit accounts with pre-tax dollars can exempt some income from taxation and defer income taxes on other earnings. Tax rates on long-term capital gains are low. Capital loss deductions can reduce taxes further. Interest income from municipal bonds is generally not subject to federal tax. Interest on municipal bonds is exempt from federal taxes and may be tax-exempt at the state and local level as well, depending on where you live. Tax-free interest payments make municipal bonds attractive to investors. Because of the tax benefits, municipal bonds' tax-equivalent yield makes them attractive to some investors. An additional benefit from investing in stocks, mutual funds, bonds, and real estate is the favorable tax treatment for long-term capital gains. An investor holding a capital asset for longer than 1 year enjoys a preferential tax rate of 0%, 15%, or 20% on the capital gain, depending on the investor's income level. If the asset is held for less than a year before selling, the capital gain is taxed at ordinary income rates. Understanding long-term versus short-term capital gains rates is important for growing wealth. For 2021, a married couple filing jointly would pay 0% on their long-term capital gains if their taxable income falls below $80,800 and, in the case of a single individual, below $40,400. For 2022, the zero-rate bracket for long-term capital gains applies to taxable income up to $83,350 for married couples and $41,675 for single individuals. A tax planner and investment advisor can help determine when and how to sell appreciated or depreciated securities to minimize gains and maximize losses. Tax loss harvesting can also offset a capital gains tax liability by selling securities at a loss. When used in the course of daily business, many expenses can be deducted from income, reducing the total tax obligation. Especially important tax deductions for self-employed individuals are health insurance premiums, which are available if special requirements are met. The Secure Act offers tax incentives to employers who join multiple employer plans and offer retirement options to their employees. In 2022, taxable income can be reduced for contributions up to $20,500 to a 401k or 403b plan, up from $19,500 in 2021. For example, an employee earning $100,000 in 2021 who contributes $19,500 to a 401k reduces their taxable income to only $80,500. Those who don't have a retirement plan at work can get a tax break by contributing up to $6,000, $7,000 for those 50 and older, to a traditional individual retirement account, IRA, in 2022 and 2021. Taxpayers who do have workplace retirement plans, or whose spouses do, may be able to deduct some or all of their traditional IRA contribution from taxable income, depending on their income. The deduction for IRA contributions is phased out for adjusted gross incomes at different levels, higher in 2022 than in 2021, depending on whether claimed on a single taxpayer's return, joint return, married individual filing separately, as well as taking into account any participation by a taxpayer in another plan. Before the Secure Act, 401k or IRA account holders had to withdraw required minimum distributions, RMDs, in the year they turned age 70 and a half. The Secure Act increased that age to 72, which may have tax implications, depending on the tax bracket the account holder belongs to in the year they withdraw. The bill also eliminates the maximum age for traditional IRA contributions, which was previously capped at 70.5 years old. In addition to retirement plan contributions, many employers offer a variety of fringe plans that allow employees to exclude the contributions made or benefits received from their income. Employees with a high-deductible health insurance plan can use a health savings account, HSA, to reduce taxes. For 2021, the maximum deductible contribution level is $3,600 for an individual and $7,200 for a family. These funds can then grow without the requirement to pay tax on the earnings. An extra tax benefit of an HSA is that when used to pay for qualified medical expenses, withdrawals aren't taxed, either. There are many IRS tax credits that reduce taxes, such as the Earned Income Tax Credit. For the tax year 2021, a low-income taxpayer could claim credits up to $6,728 with 3 or more qualifying children, $5,980 with 2, $3,618 with 1, and $543, if none. The American Rescue Plan, signed by President Biden on March 11, 2021, includes generous tax breaks to low and moderate-income people. For 2021 only, the size of the Earned Income Tax Credit will increase for childless households. People without children will be able to claim the credit beginning at age 19, instead of 25, with the exception of certain full-time students. Students between 19 and 24 with at least half a full-time course load are ineligible. There is also the Savers Credit for moderate and lower-income individuals looking to save for retirement. Individuals can receive a credit of up to half their contributions to a plan, an IRA, or an ABLE account. The Child and Dependent Care Credit can, depending on income, help offset qualified expenses for the care of children and disabled dependents. President Biden's American Rescue Plan also made changes to the child tax credit for 2021. The age limit for qualifying children also rises to 17, from 16.